And give me 2 seconds and I start the thing because it takes like a few seconds to prepare.
Thanks.
Okay, and I'm starting now.
Hello, James.
We see you.
I think we can open the meeting. Good afternoon, everyone, and very welcome to this SEPS webinar, How Robust is the EU Recovery? We thought that it is time to take a look basically at the recovery of the EU after the unprecedented fall in GDP in 2020. The EU economy is actually recovering in a quite impressive way. And a key question is really how strong this recovery is, whether this will continue in a truly long-lasting way, and whether there are factors of risk which could jeopardize such recovery. And I think this question actually comes at the very right moment, because on Thursday, 11th of November, the European Commission has released the autumn economic forecasts. So I think it's good trigger for our discussion. So before I introduce you the speakers, I will actually introduce each of them when the due time comes. I would like to directly give the floor to Laura Bardone, who is the head of unit Economic Situation Forecast, Business and Consumer Surveys at DG ECFIN, the European Commission, who can present us the main messages coming from the new autumn forecast. Laura, the floor is yours.
Yeah, but Cinzia, now I'm oh gosh. Now I don't know how to share my screen any longer.
Laura, I can do it. And then you just tell me when I need to move the slides if you want.
Because I don't see any longer, I don't know. It's, oh geez. I would have, okay. Tac. Okay, now I see it. Okay. The usual moment of panic. Share. We are getting there. You see something?
Yes.
You see. And now I put slowly but hopefully safely the slide in full screen. Safely, not quite. Why is it doing that? Well, I start like that while this fellow here start. Oh, I see. Okay.
Laura, I'm afraid we do not see the slides. We just see a black screen.
Ah. Perché? Perché? Perché?
Because I think it's the different window. Yeah, now we can see. But
do you see?
Yeah, now. Yeah, oh. Please use this setting.
Okay. I use this one. I'm sorry, it's not the full slide presentation. It's okay. It's not in presentation mode, but okay. Let's be happy with this one. So I start first with the headline figures of the autumn forecast. Indeed, we came out last Thursday, and the cutoff date of the forecast was 25th of October. And we will come back to that because we didn't have all the numbers that we needed to have on that date. The numbers for the euro area and the EU, I focus on the EU, is we have a real GDP growth rate at 5% in 2021, going down to 4.3% and to 5% in 2023. So basically, this is slightly higher for 2021. We had 4.8% in the summer. and slightly lower for 2022, we had 4.5%. Inflation has been revised up compared to summer for both 2021 and 2022, and quite significantly so. We have for the euro area, maybe it makes more sense to talk about inflation in the euro area. We have 2.4 and 2.2. So for both 21 and 22, inflation is above 2%, but then it would go below 2% in 2023. So these are the main numbers. This is a bit of our summary, the summary picture of the forecast for the EU. First important thing to note is that basically, yes, we are here, here. In the third quarter of 2021, so in the summer, the EU reached the pre-pandemic output level. So basically, so the level of output, the volume of output in the summer was back to the level that it had reached in 2019 Q4, fourth quarter of 2019. Note that for the third quarter, for the summer, we include a forecast. So on 25th of October, we did not have yet the preliminary flash estimate of real GDP for the, I think, 9 member states. But okay, on aggregate, we went very near to the number that we had in the flash estimate was basically close or the same as our forecast on aggregate. We differ a bit on the composition by country. What is also okay, so one important finding is this: we are back basically to the pre-crisis output level in Q3, and therefore now the EU is moving, has moved from recovery to expansion. And the second important result of the forecast is that real GDP is now expected to converge to the level that was expected before the pandemic hit, based on an extrapolation of trend growth in the winter 2020 interim forecast. And this would happen in early 2023. So this is quite, according to our forecast, quite a fast recovery. I would say unprecedented, and basically in early 2023 we are back to what we were an extrapolation of the winter 2020 forecast, which came out in February 2020, so just before the big impact of the pandemic. Of course, this is a forecast which is subject to many risks, and we are seeing headwinds coming a bit against the good momentum, growth momentum that we have seen in spring and summer. On the one hand, factors limiting production, so supply bottlenecks and constraints. The first chart shows data from the business and consumer surveys. Exactly, when business managers are asked what are the main factors limiting production in manufacturing, the first chart is, and you see that there is a big spike in the share of managers reporting shortage of material and or equipment as a main factor limiting production. You also see a spike in managers reporting shortages of labor, whereas demand is no longer a very important factor. So there is a lot of demand, but shortages of material and their equipment and labor are constraining production, according to the business managers. We have more or less the same picture for construction and services and retail trade. although, for example, for services, shortages of labor are more, seem to be more important than shortage of material and equipment. On the right-hand side is the other big headwind to both the growth picture and also the inflation picture, the big spike in energy prices that we have seen recently. Of course, energy prices fell sharply in 2020, and now they are increasing, but they are increasing over and above the level that the pre-pandemic level. Here, the chart shows wholesale prices for oil, gas, and the overall energy raw material bundle. And of course, what stands out here is the sharp increase, to say the least, of the wholesale gas price, which spills over into wholesale electricity prices, and which is expected to stay there, these high prices to stay there for a while. Despite these headwinds, we believe that the fundamentals remain strong, and they push economic expansion. So these remain there, and the drivers of growth over the forecast horizon remain private consumption and investment. Private consumption would be fed by confidence, which remains very high, well above pre-crisis levels, and the long-term average would be propped up by an improving labor market situation, and also a projected decline in the saving ratio. Now, on the savings, there remain also by the end of the forecast horizon a large amount of accumulated savings, but the saving rate goes down, and it doesn't even go below the pre-crisis levels. It stays at a notch above, but still that is still feeding a lot of consumption, well, quite a good amount of consumption. And then we have investment also pushing, driving growth. Investment is both public and private consumption. The favorable financing conditions are set to stay throughout the forecast horizon. Demand is strong, and last but not least, the recovery and resilience facility are there to support investment, like I said, both public and private. Labor market is always is the one where we always have a bit of lagging indicators. So we have a good picture of the labor market, but only dating back from the second quarter of this year, based on LFS data, and then we have some fresher data from the unemployment, on unemployment, and that's it actually. So in the second quarter of 2021, basically in spring, the employment headcount measure and hours worked were still a bit below the pre-pandemic levels, but with improvements compared to the previous quarters. Also, hours worked per person were still below, and unemployment was still a notch above the pre-pandemic level. But then in August, the latest figure we have, in September, the unemployment rate in the EU basically returned to the pre-crisis level. We do miss a bit the picture on the participation rate, so we need to see what happens there. In the second quarter of 2021, on aggregate in the EU, the participation rate was still below the pre-crisis level, but also improved compared to the previous quarter. There is this measure of labor market slack that we look at, the Eurostat measure of labor market slack that we look at, which includes not only the unemployed, but also the inactive who are either available for work but not seeking work in the ILO sense, or seeking work and not immediately available for work. These two groups had actually increased a lot during the first wave of the pandemic in 2020. It now went down, but remains still a bit above pre-crisis levels. Okay, but the fact that the unemployment rate in September was basically back to pre-crisis levels makes also me think that the participation, the labor force is also back to where it was before. So, okay, overall improvements in the labor market, and to an extent where, as I showed earlier, there are also labor shortages coming up, and coming up quite in a quite big way, actually. So throughout industry, services, retail, trade, and you know, as highlighted by the vacancy rates and the share of business managers reporting labor shortages as a factor limiting production. So the picture on the labor market is quite unclear, and possibly also the fact that there are still some workers on job retention schemes plays a role in this fuzziness. What we have from the data, from ECB data, is that the share of workers on job retention schemes has already decreased a lot, even if all these schemes are still pretty much in place. There is less of a take-up of them, and so some 2.7% of the workforce in Q2, if I remember correctly, were on job retention schemes, and that contrasts with the above 10%, if not even 15%, at the height of the crisis. So definitely the situation in the labor market is improving, and actually in the forecast we forecast headcount employment to not only to go back to pre-pandemic levels in 2022, but to go above and actually hit a record high in 2023. The decline in unemployment would be a bit constrained by the fact that inactive people re-enter or enter the labor market, but still the unemployment rate would continue declining over the forecast horizon. Now the big issue, the big question that is very much debated nowadays is the inflation forecast and the inflation profile. Basically, the question is, to what extent are the very high, strong inflationary pressures that we see now, will they become entrenched and thus lead to higher inflation throughout the forecast horizon, or will they subside? Okay, our take in the baseline of our forecast is that the inflationary pressures are pretty much transitory. You see here, the slide shows our profile for inflation and the future prices for energy, for gas and electricity. So let's start with the future prices for gas and electricity. Future markets tell us that prices are set to remain high until basically just after winter 2022, and then they will be correct sharply downwards, although they will remain above pre-crisis levels. And you see that the inflation profile that we have in our forecast pretty much follows the same profile. So there is the big spike driven mainly by the energy and unprocessed food, and then inflation would go down as from basically the first quarter of 2022, and then in 2023 it would stabilize at just a bit a higher rate than the pre-crisis levels. So basically, bottom line, our inflation forecast takes account of the fact that much of the pressures, inflationary pressures that we see now, are related somehow, to some extent, to the pandemic crisis. There were deflationary forces in place in 2020, and now there is a rebound in inflation, somehow going above the pre-crisis levels, but also related to the bottlenecks, to the supply constraints, and then little by little demand and supply better match each other, and the inflationary pressures will subside. In all of this, there is a bit the assumption, expectation that wages will not create major inflationary pressures or major second round effects because of a number of reasons, because of the expectations of inflation that is only that inflationary pressures are mainly transitory, because of the new indexation mechanisms that are not like translating inflation into wages automatically, as was the case years ago. And so far we don't see basically major wage pressures coming from the contractual wages indicators. A little digression into the public finance situation. So in 2020, the general government balances of the member states deteriorated a lot under the impact of on the one hand, the policy support that was put in place by the member states, and the operation of the automatic stabilizers that slashed down revenues. So deficits went up a lot. For 2021, we do not really see a big decrease. Actually, we see more or less a stabilization of deficits in 2021, because many of the support measures are still in place. And then little by little, the deficit at aggregate level in the EU is set to halve in 2022, and then to decrease further in 2023. The debt follows a bit, of course, the deficit developments. It would actually increase slightly in 2021 and then decrease slightly in 2022 and 23. Deficit, the public finance situation of the member states improves, while public investment increases. And this is to a large extent public investment which is nationally financed, but also financed by the Recovery and Resilience Facility. This is overall a good picture, no? Because we have an improvement in the public finance situation, which is not achieved through slashing public investment. Okay, coming to the uncertainty and risks. First of all, I wanted to present to you a new measure of uncertainty that we have embedded in our business and consumer surveys as from May 2021. So we have included in the business and consumer surveys that we promote, or that I'm responsible for, a question to business managers and consumers alike on how difficult they think they consider to predict the situation of their business and their finance and their household finances, to predict it. So basically, it's a direct measure of uncertainty. And okay, as I said, the question has been included on a regular basis, that is on a monthly basis, in our business and consumer surveys as from May 2021. But we have some results for some countries and sectors as from April 2019 on a pilot basis. And from this, we have constructed an uncertainty index. And this shows the evolution of the index, of the aggregate index here in purple, and also of the index by sector. So what do we see here is that uncertainty spiked during the first wave of the pandemic, when the pandemic took us by surprise. The lockdown measures were unprecedented. The containment measures that were put in place by the member states were unprecedented. And so uncertainty just completely spiked. Then as people got used to living with the pandemic, as the pandemic as the health situation started improving, and also as the containment measures started being lifted, uncertainty went down. There is a bit of a new spike in uncertainty in around winter 2020-21, so late 2020, early 2021. As you remember, during basically the second wave hitting the EU, and a new round of restrictions being put in place in the EU. But the situation differs across countries, across sectors. So the red line, you see that there is hardly any, there is no spike actually. So in industry, there is no spike in uncertainty, because the new round of restrictions, that's our interpretation, the new round of restrictions did not really affect the manufacturing sector. It instead affected services to a large extent and retail trade, and there you see the impact on uncertainty. Where are we now in terms of uncertainty? We are certainly much lower than we were in the first half of 2020, but we are still with quite a high level of uncertainty compared to pre-crisis. So this is about uncertainty, and then risks. Risks, of course, we need to, first and foremost, the big risk is, again, pandemic, COVID. And we basically see now new COVID outbreaks that may lead as a risk to new restrictions that may impact economic activity. Although there, I think it's important to note that the relationship between the pandemic developments and economic activity has become much looser now compared to the early phases of the pandemic, because there is again experience living with the pandemic, experience living with the restrictions, and the restrictions are not proper outright lockdowns. They are selected restrictions that, to the extent possible, do not impact too much on economic activity. Another risk on the negative side is possibly the supply side bottlenecks and constraints could last longer than expected, and therefore really weigh down on activity more than we expect now. And then again, we could have more persistent cost pressures and energy cost pressures. Especially the fact that our forecast is based on the assumption that the pandemic does not cause major economic disruptions over the forecast horizon, basically tilts the balance of risks to the downside. So, if you could argue that the pandemic assumption underpinning our forecast is benign, and therefore the risks to the downside prevail over the positive risks. On the positive side, however, we do have some risks. First of all, higher spending of household savings accumulated during the lockdown. As I said before, in our forecast, the saving rate of households declines. It does not decline below the pre-crisis level. And basically, accumulated savings are not reduced to any extent. So there is still a lot of accumulated savings in the economy, and households could spend more of those. And also we see a more a positive risk, which could be a structural one, in the sense that RRF and also the pandemic-induced structural changes could bring to increases in productivity, durable increases in productivity that favor the economy.
Okay.
So this is, and I put back the slide here, maybe.
Many thanks, Laura, for this quite complete overview of the forecast. I would like now to invite the other speakers to come in. And as a first, I would like to give the floor to James Watson. He's Director of Economics and Business Europe. Laura mentioned investment close to consumption as one of the main drivers of the recovery, both for 2021 and 2022. James, maybe your views and the views of more the business sector on the future outlook. Please, the floor is yours.
Thanks a lot, Cynthia. Thanks a lot for having me. I presume you can hear me. You can't see me though.
We can see you and hear you.
Oh, you can see me and hear you, even better. I can't see myself, but okay. Yeah. So thanks a lot. Thanks a lot again. I think great to be discussing the economic situation. We don't do it often enough, but it's obviously particularly intriguing, I think, at the moment. Yeah, you mentioned business investment. I think that's one area where I think I fully agree with the Commission assessment. Business investment is strong at the moment. I think it's benefiting, as the Commission have outlined, from favourable financing conditions. There's obviously a lot of investment needs out there at the moment as well, with the digital and green transitions, and businesses obviously playing their role in that, and to some extent supported by the recovery and resilience funding as well. So I think business investment strong at the moment, and it had a little bit of catching up to do. Obviously, it dropped during the crisis. But moving on to more broader things, really, I think that the topic for your seminar is the right one. How robust is the EU economy? And I've got two broad observations there. Firstly, obviously there's, and I'll let others talk a little bit more about this, but there's obviously huge macroeconomic support there at the moment. Obviously very, very accommodative monetary policy. Huge discussion at the moment about inflation. We're still hearing this story, really, that what the inflation that we're seeing is temporary. But I think as every week goes on, the dial seems to be turning a little bit, and we're recognizing that it might not be quite as temporary as we've been assuming. Noticeable, for example, that the Commission has put up its inflation forecast there. I do have a little bit of a concern, actually. The labour market is clearly very tight, much tighter than we'd expect it to be at this time in the economic cycle. And I do wonder if workers are sort of changing their behaviour a little bit, if people have changed their behaviour, the great re-evaluation during COVID. I think the FT said that people just want to stay at home in their yoga pants and play with their dog. Well, that might be overplaying things a little bit, but maybe some people are thinking, well, maybe I've accumulated savings during the crisis. I'm a year older, and I don't want to work quite as much as I did. So the labour market's tight, and I think inflation is clearly a concern. And obviously, on the fiscal side as well, it's worth remembering that Spain, France, and Italy all expected to see public borrowing above 5% in 2022. And actually, those countries still above 3% public borrowing into 2023. So it's a recovery that's, as I say, been supported by very, very accommodative monetary policy, and expected to continue to be relatively accommodative even into 2022. My other concern about the recovery is clearly around COVID. I think it's worth emphasising, and I don't think this comes through enough in the Commission forecast, the COVID situation is still even before the the increases we've seen in Europe in the last few weeks, still having a huge impact on the economic situation. As Laura mentioned, household savings, very recently, they're above 20%. Compared to a long-term average of 13%. So yes, we've seen retail sales pick up, and also we've also seen pickups through the summer in hospitality and travel. But those sectors in particular are still very much below pre-crisis levels. So on the one hand, it's a positive that there is scope for much more consumer spending to drive the recovery. But clearly, clearly that the COVID situation remains a huge risk. And I would emphasize as well the fact that it's not only about the legal restrictions that are going to impact on consumer behavior. Quite a literature on this, for example, if you read Adam Twoo's, he has a good summary in his book, that actually consumers are reacting to the environment, they're reacting to the signals from government. So quite often they'll reduce their activity outside of the home, even if there are no legal restrictions. It's a signal that sometimes governments are sending. It's not the actual legal restriction that reduces the activity. So there was a story last week, for example, I think in Belgium, the HoReCa sector, I don't know, I think they'd seen a fall in bookings for events and such like, and that was before any restrictions had been put in place. So I think there's still a huge potential downside and upside from the COVID situation, but I think very, very important to remember that. So I'll leave it there because I know others that will have many points to add.
Many thanks, James. I would like now to move to Daria Ciriaci. She is the Vice President for EU Affairs at Cassa Depositi e Prestiti. So Cassa Depositi e Prestiti is the Italian national promotional institution. When we talk about recovery in the EU, everyone wonders about what is happening in Italy. Also because in this panel, Italy is overrepresented and gender biased in the right sense, sorry for the comments. And of course, Cassa Depositi e Prestiti has an important role when it comes to investment in Italy. So maybe Daria, what is your view on the current situation, and maybe what is your perspective in the longer term, given that CDP is very much interested in a longer term perspective? Please, the floor.
Thank you, Cinzia. I would say that it's quite unusual that we have a gender balance going in the female direction in Italy, but that's only a comment. And I agree with James that a lot of people would like to be in the yoga pants at home, maybe even me. But having said that, first of all, thank you a lot for inviting me, and thank you, Laura, for sharing with us the main findings of the autumn economic forecast. Well, as she said, the recovery seems quite strong so far, and I'm sure as also Daniel will complement after, the macroeconomic outlook appears quite positive. And I do believe that it's very good to see that the EU GDP is already above 2019 levels, even if the largest EU economies have not reached pre-crisis level yet, but they are all supposed to fully recover between the end of this year and the next one. I would like to, having said that, I would like to focus on, during my short contribution, on the fact that no matter how strong and solid the recovery is, there is a fundamental need for more investment to fight climate change and digitalize the EU economy and boost, let's say, this growth and make it more structural. Okay, so I think that we all agree that this is I would say a make or break moment to accelerate the transition. And at the same time, we cannot forget that digital and climate action goes on hand in hand, and that this twin transition is not for free, in the sense that we need to fund it. And here comes the EU with its fund, national programs, and national promotional institutions like Cassa Depositi e Prestiti in Italy, I don't know, but KfW in Germany, CDC in France, and so on. What I would like to stress is that the Commission estimated that achieving the 2030 EU climate target would require something like 360 billion per year of additional investment. Okay. Then we have to fund the EU digital transformation, and I've read some estimates saying that this will cost no less than additional 125 billion per year. So I agree with what James was saying. You know, that the business sector, let's say, is a particular intrigue also regarding this potential additional investment, because these yearly amounts, we speak about almost 500 billion per year. This is a sum larger than what is made available by the Recovery and Resilience Facility for Climate and Digital Investment and Reforms over a 6-year period. So we are really speaking about a gigantic amount of investment. I wonder, and I would be glad then to listen also to the opinions of the other panelists. I mean, will all EU member states be available to find the resources needed to fund this twin transition? Will be enough, let's say, fiscal space to fund all these investment? And we need also to consider that there are several risk factors that may affect this growth strategy. Laura and James mentioned the COVID-19 pandemic. It's true, it's not over. Coronavirus cases are on the rise across most EU countries. New restrictions may be required and impinge the recovery. Maybe more funds are needed to counteract that. We don't know it. We need to vaccinate the entire world. And this also means that additional funding is needed. Some of it must come from the EU. Second, as I was mentioning, is not clear how much room is left for expansionary fiscal policy, considering the gigantic amount of early additional investment needed. And we have already observed, as Laura has shown to us with this presentation, that we already recorded high increase in public debt in the EU. And we know that what is good about public debt is it must be sustainable. Well, a lot of this will depend on how public money will be spent and the extent to which the proposed investment under the different recovery plans and the necessary reforms that will be implemented will increase productivity and employment. We don't know it yet. Third, and James was mentioning that it is not clear how much room is left for expansionary monetary policies. No? Business investments were so sustained also because let's say that their financial cost is low given the low level of interest rate. The true question is what he was mentioning now, is the inflation, are we observing temporary or permanent? And then there is the question of if, how, and when central banks will react, maybe with a more restrictive approach to monetary policy. Now, against this background, let me conclude mentioning the role that national promotional bank and institutions such as Cassa Depositi and Prestiti for Italy have played so far to counteract the crisis and are playing to bounce back better. As you know, MPBI are passionate long-term investors who have as a mission that of contributing to sustainable growth and jobs. This is simply in our DNA. So we act as market operator, but we focus on long-term impacts, investing in strategic infrastructure, social infrastructure, digital, as well as energy and transport. Was just to mention some of them. We invest in companies operating in strategic sectors, support SMEs, startups. So we are really, let's say, core key investors in our respective countries. We also transform, in some cases, our our role. So, for instance, in the case of CDP in recent years, we've transformed ourselves from being a lender to a promoter of territorial and infrastructural development. So a business partner for the public administration. And we'll see if this role will even increase in the future to the extent that will be involved in the implementation of national recovery plans. This applies to us, but also to our European sisters. Another aspect that is worth mentioning in this context is that MPBI may combine their own resources with those made available at the EU and national level and further catalyze private investment. Just to give you a number that was quite striking, we have doubled our commitment comparing in 2020 compared to 2019, exactly because of what we try to sustain our respective economies. And when it comes to EU programs and funding, MPBI will contribute to the implementation of many programs, starting from the Invest EU or the Connecting Europe Facility, European Innovation Council. So the money, I would say, is there. The context may change, but we will continue, of course, providing our business sector with the funding they need. And I would stop here, and I'm of course happy to answer to your questions later, Cinzia.
Many thanks, Daria. Before I move to Daniel, maybe let me invite everyone who has a question to type in the question using the Q&A function. We already have a couple of questions, but in case anyone would like to contribute to the debate, please feel free to do so. I would like now to move to Daniel. Daniel Cross is a distinguished fellow at CEPS. Daniel, many things have been said. Maybe good opportunity for you to react or to add a new angle.
Yes, Cinzia, it's a pleasure to participate today. How robust is the recovery in the EU? To be honest, we don't know. We have noticed a very strong recovery. We are pleasantly surprised, most of us. Will it continue? We hope so, but we cannot really guarantee. And here, I wanted to make 2 points which start with this time is different. In a sense that this time is different than the last crisis we have had in Europe. The first, it's different, it's quite clear. We have a V-shaped recovery this time, whereas it was painfully slow the other time. Recovery is supported, of course, by very favorable financial conditions, whereas we had tension in financial markets 10 years ago. What determines the difference in the recovery and the depth of the recession in different countries? It's difficult to say. Tourism should play a role, but doesn't seem to be determining the overall results. And I have the impression that here it is really very difficult to predict which country will do better than another. Industry first was less affected. Now we have all the supply chain disruptions. So it's very difficult to say which country will do better. But of course, fortunately, in the EU, we have a basket of many different cases, so it should average out. The second aspect of this time is different regards fiscal policy. We have seen an extraordinary amount of fiscal support, and maybe actually we have to unlearn part of the lesson we had from the last crisis. The lesson from the last crisis was that when you're in a recession, spend big so that the recovery speeds up. Here, it is not so sure that a bigger fiscal package actually has a big impact on the recovery. Now, let me make one aspect clear. I'm not talking about replacement income. It's quite clear that every government had to provide replacement income. The question we should ask ourselves is, to what extent providing much more support than replacement income, so going beyond what was needed to provide people with approximately the same income as before, whether that had a strong impact on the recovery. Across Europe, I don't think one finds a very strong relationship. Actually, the Nordic countries, which had the least fiscal support, relatively speaking, had the shallowest recession, but that might have been because they just handled the pandemic better. In our piece, which we have published today, we make another observation, which is based on a transatlantic comparison. We notice that in the EU and the US, the strength of the pandemic was similar. In the US, the fiscal support amounted to about 15, close to 16 percentage points of GDP, compared to quote unquote only around 6-7% for the EU. Meaning that in the US, fiscal support was, let's say, almost 9 percentage points of GDP larger. And I would say they have nothing to show for it. So that's a multiplier close to 0, not as a repeat of providing replacement income, but going beyond providing replacement income. And I think this should give us some food for thought, because as Laura said earlier, we're still expecting deficits to be quite high in 2022, when GDP will have fully recovered. Do we need that at that point? Do we need still deficits which are 2 percentage points higher on a cyclically adjusted basis when the economy is actually expanding very nicely? So that is, I think, something where we should ask ourselves whether this time is different and whether we unlearn something, have to unlearn something from the past. Why this difference? It's quite clear why. In the past, in 2008-9, and then 11-12, we had financial markets that didn't work, and many consumers and firms were cash constrained. Now, the one thing one can say about consumers that cash constraints are not the major impediment to consumption, nor is the lack of credit or access to credit an obstacle to investment. And therefore, really, the case for fiscal support is now much, much lower. So I would say we have so far had a very strong recovery. I would say even with much more modest fiscal support than the US, and we could probably diminish that a bit. Going forward, I found it interesting that now the Commission predicts that actually we will overtake the previous time path, which would be very different from the last recession. And my only question is whether we could expect to happen even if COVID becomes endemic. And I think what we have seen over the last month shows that very likely COVID will be endemic. At what level, very difficult to say. So my main question would therefore be, so far so good. Maybe we can reduce a bit fiscal support, but the real underlying question is, how do we deal with endemic COVID?
Thanks, Daniel. There is actually a question which goes a bit in your direction, and I would like to share it with everyone, and then maybe ask Laura and the others if they want to intervene. And basically the question is the following, said based on this general optimistic forecast, could we advance the hypothesis that the economy found a way to grow with the pandemic? So are we there? Then the question continues, it seems that the human dimension of the crisis cannot be reflected in statistics. So maybe we are just, okay. So, and these participants ask for comments. Anyone who would like to react to this question, and the one that Daniel asked about what can we expect if basically COVID becomes endemic and is there to stay for a while? Laura, James, or Daria, would you like to react to this?
Yeah, maybe I can give my 2 cents. I mean,
yep.
First of all, maybe COVID is becoming already endemic. wave after wave, we say, okay, this is over, but then it is certainly not over outside the EU. It is certainly not over, especially in some countries of the EU. And it seems that even with the vaccines, it's not over. So I think there is a bit of an endemic element there. But like I said, I think there is a bit of getting used to living with the pandemic, I think. And also, you know, okay, I take the point of James, that if you look at the still very high accumulated savings, then you think that, okay, consumers are still a bit holding on to their savings for precautionary motives, I guess, mainly. There is maybe also the fact that in 2020, there was a big shift of consumption towards durable goods and away from services. And when the services reopened, there is a limit to how much one can recover the amount of services he did not consume during the pandemic. So this is basically bygone consumption, in my view. Now the question, what if COVID becomes endemic? And then we have to think, I mean, would it not cause a structural break in, I don't know, in the consumption behavior of economic agents, but without really bringing down the, I mean, we have seen that consumers, for example, consume differently, but still consumed even in 2020. Could this adaptation not be brought forward in the future? And also, you know, we are talking about new restrictions being reintroduced in the EU, in many countries of the EU. Okay, let us put aside the countries where the vaccination rates are very low and where there is a big surge in hospitalization and deaths. But I don't know, my view is that if restrictions are, you know, the use of COVID passes and the so-called green passes, depending on how they are called in the different countries, as far as I'm concerned, for example, I consider it more as a guarantee of safety than anything else. So I'm more keen to, you know, to go out if I know if that going out is restricted to the very large share of the population that has been vaccinated. Okay, this crisis is different. This situation is new to us. But I don't think that an endemic COVID crisis could basically freeze the economy.
Okay, thanks. James, I think you want to add?
Yeah. So essentially, what the suggestion is that somehow we've got through this crisis, and in a couple of years' time, we'll basically be at the same output level. And hence the crisis won't have impact us in the long term. So, you know, it's a nice scenario. I think we're far too early to be able to think that, really. I mean, Laura's right on one point, which I think needs bringing out, that a lot of the lost consumption through the crisis was service activity that has just been lost. So people didn't go to the restaurant, and that didn't happen, and that was lost in that year, in the sense. But the idea that somehow we haven't lost any of that productivity growth, you know, as people are at work, and the huge sectoral shifts and structural disruptions that we've had, I think that's optimistic, to say the least, really. So, not least, there's been distributional consequences from that lost output. Above all, governments have obviously taken on huge debt levels. So even if we have on a new growth path. You're obviously in a situation where governments have that higher debt levels. Okay, we're in a low interest environment, and it can be paid back more slowly, but it will need to be paid back. That has potentially impacts on incentives if we have to raise tax levels. So I would be skeptical that we're going to end up on the same growth output trajectory that we thought we were going to be on 3 years ago.
Daria, would you like to add your point of view?
Actually, James said exactly what I was thinking. Let's also consider that it's not the economy found a way through the COVID crisis. I mean, the economy has been supported with a huge amount of EU and national resources, including those of NPDI, and the crisis had a huge social impact on our economy, and it may have created a shortage also of labor and redistributional consequences that will not be easily recovered.
Thanks. We are running out of time, but I think there is one question which is actually interesting, and it's more a clarification. This is for you, Laura. There is a question about the inclusion of the RRF investment in the forecast, and basically whether all approved RRP have been incorporated, and to what extent is the forecast contingent on the good implementation.
Okay, we include the RRF for all the member states. And we have actually council implementing decisions endorsing the recovery plans basically only for 22 member states. We have not received a recovery plan for the Netherlands, and the recovery plans for a number of countries, including Hungary and Poland, do not still have endorsement. So in those cases, so in the cases of countries that have submitted a recovery plan, but the recovery plan has not been endorsed, there we use technical assumptions. Basically, we include RRF funding and expenditure funding on a linear basis, starting from 2021, so pre-financing including, and we include to the extent possible the expenditure as we know it from the recovery plans. For the Netherlands, we include a recovery plan, funding from 2022, and expenditure based on a linear absorption profile. So basically the allocation that for the Netherlands divided by the number of years over which of lifetime of the RRF. For the moment, I think the question was really about do we take account of absorption capacity of absorption of EU funds when including the RRF. For the moment, we tend to basically buy the recovery plans and not discount by what we know about absorption capacity in the member states. So we wait to see how the implementation is actually going. So there is also the assumption underpinning the inclusion of all recovery plans that targets and milestones are duly respected.
Thanks very much, Laura, for this clarification. We are already 5 minutes over time, so it is time to close. Maybe just to takeaways from the discussion, I think we are all quite happy to see that actually the recovery is good and is expected to continue for next year. But I also have the impression that there are quite a bit of different views on the role of policies and policy support in terms of driving or determining the outcome in the economy, and what policies should do in the future. So certainly we will have other discussions on this point. For the moment, I would like to thank Daria, Laura, James and Daniel for their participation, and all of you who stayed with us for this hour. Thank you very much, and see you soon. Bye-bye.
Thank you.
Bye.
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 Bye-bye.
Bye.
Bye-bye.